afternoon. This is January 2023, and welcome to the Novare Capital Market Insights. I'm Todd Patton. This is Senior Investment Team Member James Harlow, and we're here to talk about our thoughts on the market. Our discussion is general in nature and should not be construed as investment advice. James, with that out of the way, to get started, could you just provide us with a summary and recap of what happened last year in the markets?
Sure. 2022 was a difficult year for both stocks and bonds. S&P 500 fell about 18%. The Bloomberg Aggregate Bond Index fell about 13%. So what they call a 60-40 portfolio, 60% equities, 40% bonds, that type of portfolio fell about 17% last year. So that would be the third worst performance for that type of portfolio on record. So it was definitely an unusual year. Stocks and bonds typically do not fall together. Usually in periods where there's a lot of stock volatility or just in general down equities, bonds tend to hold up a lot better. They tend to be more stable and just kind of provide that ballast for portfolios. But because inflation was so high last year and the Federal Reserve had to respond so significantly with interest rate hikes, that put a lot of pressure on both asset classes. I mean, you saw Federal Reserve went from close to 0% interest rates in March of last year up to about 4.5% by December. So that's just a rapid increase in the federal funds rates, the fastest that they've raised rates since 1980. So that was just an environment that was quite unusual and caused both asset classes to fall. As you can see in this graphic, up on the screen, this 2022 is only the second negative year for the S&P 500 since the 2008 Great Financial Crisis. So, in general, over the past 14 years, returns have been quite attractive. But we've had 2 years over that period where the markets have been down.
Yeah. So I guess that's encouraging to know that after we have a bear market like this, we tend to have a bull market, and bull markets tend to last longer and be larger in magnitude. But before we get there, looking back at last year, what was it about the raising of the interest rates that caused both stocks and bonds to fall at the same time?
Sure. So typically stocks and bonds can behave just fine in rising rate environments, just provided that there's a good economic backdrop and that rates are rising gradually. And that was the big difference between those time periods and what we saw last year was just the rapid increase in interest rates just caused a lot of disruption to both stocks and bonds. Just specifically on stocks, rising interest rates pressure economic growth, and that in turn pressures corporate earnings growth. So that's number one. Number two is that rising interest rates increase the cost of doing business for corporations, specifically through higher debt costs. In general, higher interest rates pressure the multiple that investors are willing to pay for equities, and particularly on growthier parts of the market like technology, communication sectors. And then when you see bond yields rise the way that they have, it makes stocks incrementally less attractive versus bonds. We went through a long period where interest rates were very low, bond yields were not attractive, and stocks were kind of the best game in town. And with bond yields being more attractive, it just makes them more competitive with stocks. And then just lastly, in terms of bonds in particular, in terms of how higher interest rates impact them. Bond prices fall when interest rates rise. So in an environment like last year where interest rates went up so quickly, that just caused a lot of pressure on bond prices and caused their returns to be a lot lower than what you'd expect.
Yeah. So as we move forward into 2023, I know I'm talking with clients and other investors. There's still concerns in the market. What do you see as the concerns moving forward?
Sure. So I would say, stepping back to last year, 2022, I feel like a lot of the uncertainty was around the Federal Reserve and how they were going to have to respond to inflation, and how quickly and how high were they going to go with rates. And I think that coming into 2023, I think we have some more visibility about what they're going to do. I think they have a couple more meetings here in the first half where they're going to do some smaller increment rate hikes, but I think we have some more understanding of that pathway. I think that this year, I think more of the concern is, what's the cumulative and the lagged impact of the rate hikes that they've already done, and how's that going to filter through the economy? and how that's going to impact GDP growth and corporate earnings growth specifically.
Yeah, and what would you say would be the positive, parts of the economy that investors should focus on?
Sure. So again, stepping back to 2022, I would say that there were just a confluence of events that occurred that are unlikely to repeat again this year. You had certain areas like supply chain disruption, Russia, Ukraine war, just China's off again, on again COVID policy. It just caused some uncertainty and disruption in the markets. For 2023 specifically, I'd say valuation is number one. Equity valuations are more attractive now than they were this time last year. We look at the S&P 500 trading about 16 and a half times entering this year. That's a lot more attractive than the 21 times it was trading at this time last year. So valuations would be number one. I'd say number two is that we would expect economic growth and corporate earnings growth to remain resilient. For 2022, we're looking at about 2% GDP growth here in the U.S. and about 5% earnings growth. And we think that trajectory can continue in 2023. Inflation is pressuring the consumer, impacting purchasing power, but we do feel like that underpinning for the consumer, which makes up 70% of our economy, is still quite healthy. Unemployment rate is at the lowest level since 1969. We're still seeing above average wage growth, and in terms of corporate and consumer balance sheets, both are healthy. And I know that there's concern out there about potentially a more severe recession hitting the U.S. economy in 2023, but we just don't see the elements there for that. If you look at severe recessions in the U.S. Throughout time, most of the time they're caused by some kind of area of the economy that's had a big boom and is experiencing some kind of bust or some kind of financial excess or imbalance that is surprising to the market. So we just don't see those conditions. We feel like we have a much better setup that we're coming into. I would say, thirdly, we do expect inflation to continue moderating. As you can see at the graphic on the screen, inflation really popped a lot last year, but we're starting to see, it looked like we had a peak back in June of last year, and it's starting to come down, the consumer price index. And, we're seeing areas like, used car prices and energy have really come down quite a bit from their highs. And we're still waiting for some of the more stubborn areas like shelter and food to come down. But we do feel like they're going to start to come down more as we go through 2023. And inflation moderating would go a long way towards allowing the Federal Reserve to back off of its hawkish Fed policy. They'll be able to end their rate hiking campaign, and that'll help in terms of alleviating some of the concerns around economic growth impacts, and just in general will help stocks and bonds behave more predictably. I would say that just lastly, just from a bond perspective, that fixed income yields are just a lot more attractive than they were this time last year. It's unlikely that you're going to see bond prices pressured the way they were last year with rising interest rates. So if you look at that 60-40 portfolio like we talked about before, that 40% bonds should, we believe will start to behave more in line with what you would expect, just more of a stable, sort of a safer area for that portfolio mix.
Right. And we also know statistically it's not real common for U.S. equity markets to have back-to-back down years. But how uncommon is that phenomenon to happen?
Sure. So as this graphic on the screen shows, it is uncommon. If you go back to 1950, there's only been 2 instances where there's been more than 2 or more consecutive down years. And one was 1973, 1974. We had a recession during that period caused by an oil crisis. And then 2000 to 2002, we had the dot-com bubble, tech bubble burst. Other than that, any time that there's been, since 1950, there's been a negative year in the S&P 500, the following year has been positive, and that average return has been an attractive 15%.
Wow, that's great. So as we move into 2023, what are just your final thoughts on the markets?
I would say that the first half of this year should continue to be volatile. The controversies that we were dealing with last year are still there. Inflation is still higher than we want it to be. The Federal Reserve is still active, still has a hawkish rhetoric out there. And then we still have the uncertainty about, as I mentioned, that impact of higher interest rates, how that's going to flow through the economy and corporate earnings. But I do feel like those some of those elements will get resolved by the middle of this year. I think the Federal Reserve will be done with their rate hiking campaign by that point. I think we'll have a better sense for how inflation is heading, and also just where's the earnings situation look like and the economic situation look like at that point. And once you get to the back half of the year, you'll see investors start to focus on 2024, where growth expectations are higher for that year, and some of these controversies should have alleviated by that point. I'd say just lastly that we continue to focus on the long term and encourage our investors to focus on the long term. That there's going to be, over the course of time, there's always going to be up markets, there's going to be down markets, there's going to be times of booming economic growth, there's going to be times of recession, and that's just the nature of market and economic cycles. But if you look at it over the long term, U.S. equity markets tend to rise more often than they fall. And if you look at going back to 1950, the average annual return for the S&P 500 is 11%. But the only way to achieve that long-term return would have been to just stay invested. And if you try to time the market and get in and out at different times, you would not have been able to achieve that return.
Yeah, well, those are great thoughts. We thank you for your time today, and we thank you for watching. We also appreciate those of you who refer your friends and families to Novare Capital. Thank you.